excuse me. Oftentimes when I put on a mask, excuse me, carbon dioxide bothers me. So I know it's really different breathing in a mask. Well, hopefully one of these days we won't have to wear them anymore. Keep your fingers crossed. I don't think it'll be during spring semester though. Nah, I think that semester is going to be just about like this one. Alrighty, so here in chapter 13, we'll take a look at it today. It's not an overly long chapter, and it is largely a review chapter, so it's a really good chapter to be covering. So for this week, I have two chapters on the syllabus, chapter 13 and chapter 24. Chapter 24 is not a bad chapter either. So I do have a handout if you need a hard copy that encompasses both chapters. Does anybody need a hard copy?
I like how the accent comes out hard on the copy. Your accent comes out really hard when you're saying copy. Yeah, that's fun.
What do I say?
Cappy?
Oh,
It's very like
yes.
Chicago-y.
Yeah, it is. Yes, that is so-called northern vowel shift. And yeah, it's something that linguists look at. It arose after World War II, and older people didn't have it, younger people did here from Great Lakes area. It is weird, I agree. Sometimes I hear it in my own voice, so I have to concentrate, not flatten that O, say like coffee instead of happy. Yeah, flatten that O.
It's unique. It's
Flatten
good.
that O. Yeah, pardon?
It's unique. It's good. Not hard.
Oh, okay. Now, another thing I have to watch is long O, because sometimes the diphthong doesn't come out. And I remember my first grade teacher telling us to watch that. O-W, it's a diphthong. So O, not O. I try to watch that one too. Okay, there, finally detected the signal from my laptop. Now we have something on the screen. Okay. And by the way, up here for our use, I guess, somebody was kind and left some hand sanitizer. And this is fancier than what we normally get around here. This is Black Cherry Merlot. Merlot. I thought we had a dry campus. I'm so worried. Alrighty, so chapter 13 here, like I said, is largely a review chapter, and certainly it's not a bad one whatsoever. So I think you'll be very pleasantly surprised. So during this start to Halloween week. Yes. And so Jackie, you got on your orange shirt. Very good. Oh, it's got a jack-o'-lantern on it. You are getting ready for Halloween. Good. Very good. So here with overall audit planning. Largely review chapter. And what we'll do is to start off reviewing the 5 different types of audit tests we have. Then we're going to put them together in an overall audit program. So let's see those 5 audit tests here. We've got 2 which have to do with internal control. So there are no numbers. Those will be procedures to obtain an understanding of internal control and tests of controls. No numbers. But then we have 3 which do have numbers. And those are so-called substantive tests because we are substantiating the dollar amount of
Well, could be analytical procedures, could be substantive tests of transactions, or could be tests of details. We'll get to those. So with audit tests, well, first of all, analytical procedures. We know and love those. We covered them back in chapter 8. Quick and easy things such as financial ratio analysis. So not to worry about those. We know what they are. They give us a general ballpark figure, but nothing very specific. That's why we always follow them up with more specific substantive tests, except for the one out where we have an account which is barely significant, and we just need a little bit of comfort about that account. Then analytical procedures alone might just do the trick. Well, then analytical procedures, we also know that we do most analytical procedures quite early in the audit because we want to know where the problem spots are. And we'll do some again at the end of the audit just to make sure things are still on track. In the middle of the audit, well, it's up to us. So analytical procedures we know are always required at the beginning of the audit, the end of the audit, in the middle, it's up to us. And I say that because I know that's kind of a favorite question on the CPA exam. Quick and easy point there and get 75 of those quick and easy points and then you pass. That's right. Well, then also early in the audit, procedures to obtain and understand internal control. We covered those in chapter 10, and they're to obtain an understanding of the controls and to determine whether they've been put in place. They will allow the auditor to assess a preliminary value for control risk. So quite early in the audit, we do things like looking over the client's policies and procedures manual. We do some inquiry, we do some observation, etc. Fairly quick and easy, just get an overall view of internal control, how good it is, how bad it is. So we get a preliminary value of control risk. Then we'll back that up with tests of controls, also covered in chapter 10, to assign a final value of control risk, possibly lowered from the default value of 100%, thereby reducing substantive tests, especially tests of details, which are usually relatively expensive. And they're to test the effectiveness of the controls. So testing the effectiveness of the controls, making sure that they are working. They're more detailed than those procedures to obtain an understanding of internal controls, so they take longer. Then we also have substantive tests of transactions. They're to test for monetary errors, which could be either unintentional errors or could be fraud, affecting individual transactions. And they will reduce tests of details, so the results are good. We know they may be combined with test controls, the dual purpose test, so kill two birds with one stone. And the textbook often refers to both substantive tests of transactions and tests of controls as tests of transactions because we're testing one individual transaction at a time. Then, usually what we try to save until the end in most audit areas because they're more expensive, tests of details of account balances. And they are to substantiate the ending balance of an account, especially real or balance sheet accounts. We can note that it's important to perform both substantive tests of transactions and tests of details due to double entry accounting, as well as to the carryover of real account balances to the next fiscal year. Because the auditor wants next fiscal year's beginning balances to be quite accurate. Those are this year's ending balances. So if we test them thoroughly with tests of details, good, we're off to a great start for next year. We want them stated accurately because they roll over and errors would start compounding. Now, there are no tests of details for most nominal accounts because their balances are closed out to the real accounts at fiscal year end. And figure 13.2 summarizes the roles, types of audit tests have in auditing accounts. Have a look at when you have a chance. If it helps, so be it. If it doesn't help, that's okay too. Some diagrams are like that. So with tests of details, usually the most expensive type of audit test, We're hoping that we save on tests of details through good audit results from earlier tests. So let's say way back that we got good results from procedures to obtain and understanding of internal control and test of controls. We know the internal control is working quite well. We also got good results from analytical procedures. That's great. Probably the books are okay. Then we did substantive tests of transactions and they turned out quite well too. So we have 4 earlier audit tests that turned out quite well. We can limit this 5th test of details in most areas. For example, with accounts receivable, we would send out fewer accounts receivable confirmations in that case. That really saves clients some money because those things get to be expensive. Then, in F, just have a look at this table as well when you have a chance. Relation of types of tests to ways of gathering evidence. If it helps again, so be it. Then, if we think about the increasing costs of tests, in other words, from lowest to highest, generally the cheapest analytical procedures, things like financial ratios are quick and easy. Once we upload a client's financial statements, for example, to Excel, Excel can even calculate most financial ratios for us. So not to worry about them, as long as we can interpret them. Then, second, test of controls and procedures to obtain understanding of internal controls, kind of a toss-up there. Third, substantive tests of transactions. They're generally more expensive. For example, it would be cheaper on sales documents to look for a credit approval number, which would be a test of control, than to recompute the information on that sales document and trace it to the posting in the sales journal. That latter would be a substantive test of transactions. So time is money, substantive test of transactions, somewhat more expensive, but definitely in most areas. What's most expensive still, tests of details. And that's a general guide because it can vary according to account or client. By the way, we can note that more precise information is generally provided by the more expensive tests. So we can say that we get what we, what's the old saying? We get what we? Thank you, you bet. Thank you, Allie. We get what we pay for. Yep. Now in H, I do want us to look at this. Variation in audit plans. I want us to go over table 13.3 on page 418 and make sense of the mix of evidence to be gathered for these 4 clients here. So let's just see if we can tell ourselves a story. So here we go. We've got 4 different audits in this table entitled Variation in Evidence Mix. We've got 4 of the 5 types of audit tests. So test of controls, substantive test of transactions. Then it says substantive analytical procedures. Again, we know that that is redundant, like saying ink pen or tuna fish or pin number. What else is redundant? Pardon? Global pandemic. Excellent, Jackie. Yes. So that is definitely in today's parlance redundant. Yes. So we have a global pandemic. Is that a national pandemic too? Oh, so okay, so national would be an epidemic. So if we said national epidemic, we would be redundant. Okay. So if we say substantive analytical procedures, we're being redundant. If we said substantive tests of details, the next one, that would be redundant as well. So we're looking at either E, extensive amount of testing, or M, medium amount of testing, or S, small testing, or N, no testing here. So let's make sense of these 4 different audits. See if we can tell ourselves a story behind them. We've got audit 1 with extensive tests of controls, small amount of substantive tests of transactions, extensive analytical procedures, small amount of tests of details. So early in the audit, this auditor did test controls and also procedures to obtain an understanding of internal control along with them, an extensive amount, and did an extensive amount of analytical procedures. How good do you think test controls and analytical procedures turned out? Really good, because he only did small substantive tests of transactions and small tests of details of balances. So based on good results from those earlier audit tests, they did not have to do as many of the other later audit tests. So test controls, internal control must be working very well. That spelled that the books were going to be okay. Sure enough, with analytical procedures, everything looked okay. So they just did a small amount of substantive tests of transactions and a small amount of tests of details of balances just to get a little bit of additional comfort. So audit 1 is a very good client to have. And relatively speaking, in terms of cost, how cost effective is audit 1? Very. Yes, very much so. Because they did more of the cheaper tests and got really good results, and fewer of the more expensive tests. And with the more expensive tests, they got good results too, you can bet. Otherwise, it would have increased the amount of those. So audit 1 is good. Then audit 2, medium test controls, medium substantive tests of transactions, extensive analytical procedures, medium tests of details of balances. Well, with these test controls, they did a medium amount. How do you think internal control is working in audit 2 versus audit 1? Not as good, no. It's not horrible, but it's not working as well as an audit 1. So audit 1 would have much lower control risk. Audit 2 would have higher control risk. It's not 100%, but it's not an ideal client. They did extensive analytical procedures. How do you think they turned out versus audit 1? Not quite as good. That makes sense because internal control was not working as well in audit 2. Therefore, since they did not get really good results with these early audit tests of test controls and analytical procedures, I almost said substantive analytical procedures there. Whoops, I don't wish to be redundant. So with not so good results from those 2 earlier audit tests, they increased the amount of the later audit tests over audit 1. So they did more substantive tests of transactions and more tests of details versus audit 1. They had to because clients' books weren't so good in audit 2. So in audit 2, that's not a bad audit client, but it's not as good as an audit 1. So with audit 2, what would you say about the relative cost of audit 2? Not as low as an audit 1, no. Because in audit 2, we did fewer of the cheaper tests, more of the more expensive tests. So it's not a horrible client, but again, not as good as audit 1. Then audit 3. They did no test controls. Automatically, control risk is what? 100%, you bet. So it could be because it went in there and they saw that internal control just wasn't good. We saw that scenario. Another scenario we saw as we discussed internal control is that it could be a small client. They don't have very formal internal control, so we don't even bother testing it. We just skip right toward an expanded substantive audit. So that's why they had extensive substantive tests of transactions and extensive tests of details. My guess is they did not bother doing a lot of analytical procedures, only a medium amount, because they said, well, we're going to be doing very extensive amounts of the detailed tests of substantive tests of transactions and tests of details. So why bother doing a lot of analytical procedures? So audit 1, audit 2, now audit 3. What would you say about the cost of audit 3 versus the cost of audit 1 and 2? Higher. They did fewer of the cheaper tests. They did more of the more expensive tests. So audit 3 is higher, relatively speaking, than audit 4. They did medium test controls, extensive everything else. Let's think about that. Well, early in the audit, they did a medium amount of test controls. And how good do you think internal control is working in audit 4? Probably not that great. They also, early in the audit, they did extensive analytical procedures. My guess is they got into audit 4 and got a surprise. They probably thought the internal control wasn't too bad, but it was. And I say that because also early in the audit, about the same time, they did extensive analytical procedures. They did not need to do extensive analytical procedures since they did extensive amounts of substantive tests of transactions and extensive amounts of tests of details. So they were already doing extensive amounts of the very expensive and precise audit tests. I think they got into audit 4 and got a little surprise. What about the relative cost of audit 4? Higher still. Again, well, fewer of the cheaper tests of controls, but extensive everything else, it's a higher cost audit. So do those 4 audits make sense there? Okay. So everything makes sense so far, Jakey and Maria? Okay, good, thanks. Put my mask on my head, that always makes me think of a yarmulke. Actually, I've seen online, some people have made masks out of yarmulkes. Yeah, I guess. Okay, I guess if I had elastic, I could take a yarmulke from home or from the synagogue and make one too. Alrighty, well, next thing we have here about audit programs. So the phases of audit programs. Well, generally, first thing we do, procedures to obtain an understanding of internal control. And then tests of transactions, test controls and substantive tests of transactions, often both at the same time as dual purpose testing, as we know, kill 2 birds with 1 stone. Then your book lists analytical procedures next, but actually the bulk are performed very early in the audit. Some performed again at the end of the audit. But again, while we try to save until last, in most cases would be tests of details because they're usually relatively expensive. Then your book, figures 13.4 to 13.8 may or may not be of help to you. If they are, so be it. If not, that's okay too. Now, what I would like for us to take a look at is an overview of the audit in the book, figure 13.9 on page 430. So summary of the audit process here. So just looking at this, we've got phase 1, plan, design, audit approach. Phase 2 will perform test controls and substantive tests of transactions. Phase 3 will perform analytical procedures. And test of details balances. And phase 4 will complete the audit and issue an audit report. So phase 1, let me look back at the notes here first with you. Then I'll come back to the book. So phase 1 in A here in the notes. We'll plan design and audit approach. And it involves obtaining an understanding of internal control of the client, obtaining background information, obtaining information about legal obligations, conducting analytical procedures and procedures to obtain an understanding of internal control, and making a preliminary assessment of those risks we've seen before, the independent variables in fact the audit risk model, which are control risk, acceptable audit risk, inherent risk, and also preliminary assessment about materiality. So these are things, again, we do quite early in the audit. These things we've all seen before. Just like I said, chapter 13 is largely a review chapter. So we'll accept the client and perform initial audit planning. We'll understand the client's business and industry. We'll perform, well, it says preliminary analytical procedures, but most are done then so that we know where problem spots are. Then we'll set a preliminary judgment of materiality and performance materiality, also known as tolerable misstatement, where we allocate account to it by account. Then we'll identify any significant risk due to fraud or error. We'll assess inherent risk. And we'll understand control risk and understand internal control and assess control risk. And then finalize an overall audit strategy and audit plan. So again, quite early in the audit, we do those things. And also rather early in the audit, we do test controls and along the way, substantive tests of transactions. Let me take a look at phase 2 back here in the notes. Now I will come back to the book. So here in B, tests of controls and substantive tests of transactions. Well, tests of controls will determine the effectiveness of the controls identified in the first phase to allow a final assessment of control risk. So we had a preliminary assessment of control risk early. Now let's back that up with test controls. Hopefully our preliminary assessment is right, but final value control risk could still be somewhat higher or somewhat lower. Then substantive tests of transactions may also provide some information about the effectiveness of the controls, but will mainly serve to provide evidence on the monetary correctness of individual transactions. And both types of tests allow the auditor to determine the extent of the remaining substantive tests. By the way, these may even be performed before fiscal year end if the auditor is confident the internal control is good. So before fiscal year end, you know, if let's say we have a client with 12/31 fiscal year end. Here we are at the end of October, 2 months early. Well, for a good client, and it needs to be a good one, we don't think there are any real problems with that client. If we were to move up tests of controls from December 31st until here at the end of October, and with this good client, internal control checks out. Control risk is quite low. Do you think it would still be quite low at the end of December? Sure. I mean, we'll verify if there have been no major changes with the client, like a new accounting software package or something like that. But otherwise, for a stable client, no problem. Then substantive tests of transactions. Let's say that we take that sample of sales documents. We reperform the math on each and we trace those to the posting in the sales journal. If everything checks out here at the end of October, how would things still look at the end of December? Should be good, yeah. So we can move those tests up to interim dates. By the way, if we're doing those here at the end of October, we're getting them out of a rather busy season when we have other clients with 12/31 fiscal year ends as well. So that's a good way to balance our workload there. By the way, some firms may even give clients a break on the price if they can move things up. And when it's really busy, move up to when it's less busy. Now, I'll get into phase 3 in just a moment, but let me come back to the book here and take a closer look at phase 2. So phase 2, perform test controls and substantive tests of transactions. So first thing we have in this flow chart is a diamond. And you may recall from flow charting, the diamond means there is a decision to make. So here's our decision. Do we plan to reduce the assessed level of control risk? If the answer is yes, we'll perform test controls. If the answer is no, we'll skip right toward performing substantive tests of transactions. So when they say in that diamond, do we plan to reduce the assessed level of control risk? They are saying from the default value of 100%. So if we think that control risk can be less than 100%, we may have preliminary judgment about control risk. Well, we think can be less than 100%, we'll perform test controls. If the answer is no, we don't think it can be less than 100%, we'll skip right toward performing substantive tests of transactions. And in fact, we will perform the maximum amount of substantive tests of transactions in that case, because that no indicates that our control risk, again, is that maximum default value of 100%. Does that make sense? Now, there is a little asterisk there. That asterisk means that if I just look at what they have here in a footnote, it says the extent of test controls determined by planned reliance on controls. Okay, well, that's true. But for public companies, SEC companies that is, they're required to have an audit of internal control, so the testing must be sufficient to issue an opinion on internal control over financial reporting. With a privately held client, we do not have to worry about that because we issue no 404 report on a privately held client. We must issue a 404 report on a publicly held client though. So for a privately held client, they can get away with a control risk of 100%. For a publicly held one, do you think they can? No. The SEC is going to take a really dim view of that. So for a publicly traded client, the point is moot. They should not have a control risk of 100%. Therefore, we should be going in there and doing test controls anyway. Further, we have to for that publicly held client because we must issue the 404 report as we know. Then, final thing here in phase 3 is we must assess the likelihood of misstatements in the financial statements. Okay. Then we have phase 3. Perform substantive analytical procedures and tests of details of balances. All right, let me take a look at my notes first, and then we'll go back to the book. So in C, perform analytical procedures and tests of details. Well, as we stated above, the bulk of analytical procedures are usually performed early in the audit, even though the textbook may lead you to believe otherwise. That's because the results of analytical procedures partly determine the extent of the other audit tests, especially tests of details. Most tests of details are usually done after a fiscal year end, but analytical procedures may even be performed before then. Well, let's say that we run a set of financial ratios here at the end of October. 2 months later, fiscal year end, 12/31. Well, if analytical procedures turn out good today, how good will they be at the end of the year? Probably still quite good, at least for that good client who is stable. I wouldn't recommend that on an unstable client like a brick and mortar retailer, but otherwise we'll be okay. So we could move them up to this interim date. By the way, in later chapters, we see here in the notes, We'll discuss some tests of details which can also be moved up to interim dates to balance the auditor's workload. So for example, if we have a good client and we confirm accounts receivable as of the end of October here, they should still check out at the end of December. By the way, moving up audit tests to interim dates requires that the auditor have good internal control and low inherent risk, low control risk. So a good client, in other words. Otherwise, the audit test will have to be performed closer to fiscal year end. So the better the client is, the further up we can move tests to an interim date. So again, that could save the client some money and balance our workload too. And then, just to let you know, phase 4D here, complete the audit. More about that in chapter 24. So let me go back here to the book and take a look at what they have. So here in phase 3, performing the analytical procedures and tests of details of balances. By the way, this is not a standard flowcharting symbol. They just kind of made this one up. So it looks like a 3-story building with an attic and a pitched, oh, here I go, roof or roof. I forget, does anybody else say roof? Yeah, no, okay. I'm alone here, I know. Yeah, the previous dean, whom some of you knew, Jim Fenton, he was from Ohio and he and I said all the same things, including roof. All right, so in this attic, they're really saying, what is the risk of material misstatement in this client's financials? Is it low, is it medium, or is it high or unknown? I mean, if it's unknown, we may as well assume it's high, play it safe. So this will let us know how much we've got to perform in the way of analytical procedures. Not so much that. Perform test key items, perform additional tests of details of balances. What they're really trying to say is that this assessed risk of material misstatement is going to determine the amount of the layer audit tests we do, especially tests of details. So we hope that we get good results on the earlier audit tests. We save on tests of details because they're expensive in general. They kind of messed that one up in the book. All righty, then phase 4, to complete the audit and issue an audit report. These are all things that we will see in chapter 24. So we'll perform some additional tests for presentation and disclosure, making sure that everything is presented and disclosed that we need. Then we'll accumulate final evidence, wrapping up loose ends. We'll evaluate the results. So are the client's financial statements fairly stated or not? We'll issue the audit report. And we'll communicate everything with the audit committee and with senior management. And that takes care of chapter 13. Any questions before we get in chapter 24? And I'm not going to get too far into it today, but want to knock some of it out of the way. Questions? Okay, good. So, do you have any questions, Jakey? I guess we lost Maria. Well, okay. I need to check. Well, it must seem a little bit strange that we skip from chapter 13 to chapter 24. I don't know why they didn't place chapter 24 right after chapter 13. But chapter 24 picks up exactly where 13 left off. There's nothing in between that we need. And just like that little chart that we saw just now, phase 4, those are exactly the topics in chapter 24. So, I don't know. Maybe they meant chapter 14, but they had a little typo there. The first digit. I don't know. So I covered chapter 24 at this juncture, and it falls right in place. So where are we in terms of the audit here? Let me put a little timeline first of all. Where we are is, and let me make sure I get my board centered here. Okay, so where we are in terms of the audit, well, we have a client with a 12/31 fiscal year end. Let's say that we're going to wrap this audit up by the end of February. Well, in 2020, we had leap year, so we have February 29. This year we don't, or next year I should say we don't. So here in 2021, let's say that we wrap this up right at the end of February. That will be the audit report date. As you recall, we are going to be dating that audit report at the end of field work, at the end of completion of anything which could change that audit report. So if we have something which happens here during field work, or we're performing audit tests, something happens with the client during field work, we are responsible for knowing about it, making sure it's included in the audit report. If something happens after this audit report date, we are not responsible like that. So it's really the limit of our responsibility. So it's an important date. By the way, do you think we would ever see an audit report date, which is fiscal year end? No, can't get things wrapped up that quickly. Just like outstanding checks would not have a chance to clear, deposits in transit would not have a chance to clear. So can't do things that quickly. No. So this audit report date, that's a very important one. Here in chapter 24, we're going to be talking about what happens in this time frame here with field work, especially as we approach the end of field work. So most everything that we've discussed in this chapter is hovering right at the end of February here, completing the audit. So looking at the introduction of the chapter, well, the functions discussed in the chapter are performed at or near the end of field work. And the term on page 768, we just saw it illustrates the functions. It's repeated several times in the chapter. So the functions we just saw there at the end of 13, well, we will encounter them time and time again throughout the chapter 24. So here in Roman numeral 2, that first function we saw, we'll perform some additional tests for presentation and disclosure. So making sure that all information is presented and disclosed as should be. We're talking about footnote disclosure. Also parenthetical disclosure, where we have things in parentheses within the financial statements. So in just looking here, many of these tests are integrated with tests for transaction-related and balance-related audit objectives. Still, some additional tests may be conducted, as illustrated by the bullet points in the middle of page 767. Let's have a look at that. See, there's that chart again. Okay. So here's some things we've got to do as we get closer to the end of the audit. So presentation disclosure. We'll perform procedures to obtain an understanding of internal controls related to presentation disclosure objectives as part of risk assessment procedures. So how does the client make sure that they have presented and disclosed everything? One big thing is they must read back through their major contracts, such as for debt. Let's say they have bonds payable. That is a major chunk of presentation disclosure right there. So we want to see that they have internal controls so that somebody always reads back through that in finalizing the financial statements and make sure that everything is presented and disclosed as should be from there. Well, then we'll conduct test controls related to disclosures when the initial assessment of control risk is below maximum, so below 100%. So then we would actually test that they are indeed reading the contracts. We might observe them doing so. We might inquire that they do so. And next, perform any substantive procedures to obtain assurance that all objectives are achieved for information and amounts presented disclosed in the financial statements. So all the monetary amounts in that debt contract, which is called for bonds payable, a bond indenture, we make sure that everything in there is presented, disclosed in the financials in the way of amounts. So let's say there's a bond sinking fund. Well, we would match up the dollar amount disclosed in the footnotes with the actual dollar amount the client has in the financial statements themselves, making sure the detailed tie-in is there in the way of any numbers. If we have a discrepancy, it's got to be corrected. Oh, it did it early today. You know, Jakey, the screen's going up. Okay. Yeah, we forgot to do our betting pool today. Was anybody going to say 437? No. Okay. Oh, well, no need to bother. Yeah. The projector's cooling down on my little screen up here, my control screen. So once that ends in a couple of minutes, I can put the screen back down. Yeah, otherwise it won't let me. All righty. Well, the next thing here in the notes, table 24-1 on page 767 illustrates the four presentation disclosure audit objectives and some examples of procedures to fulfill each. So let's have a look at that here. It would be really nice if I had the projector, wouldn't it? Okay. Actually, let me come to C. Then maybe the projector will be back up. The completeness objective can be especially troublesome when it comes to presentation and disclosure. Here's the problem. Maybe not everything is included in presentation disclosure that should be. So omitted information, or shall we say understated information, is always a problem with clients. They may not have everything in presentation disclosure that should be. So this is because the client may not disclose all necessary footnote and parenthetical information in the financial statements. And this can sure occur in many areas. Good, it's coming back up. Okay. Take a minute for that projector to fire up. Well, this can occur in many areas again, but very often occurs to the client's contingent liabilities, as well as the various contracts client may have. So they may leave off some contingent liabilities, we'll get to those next, or they may leave off some information in some contracts. So completeness, always a problem when it comes to presentation and disclosure. I will come back to B and show you the table on page 767 that illustrates the four presentation and disclosure audit objectives. We've seen them before way back. And again, examples of procedures to fulfill each. And it should be back up in just a little bit here. We'll wait a moment. There we go. Alrighty, so presentation and disclosure audit objectives. One that we saw way back was occurrence and rights and obligations. So disclosed events and transactions have occurred and pertain to the entity. So everything disclosed, like in footnotes, has really happened. It is validly occurring information. An example of the substantive procedure here is to review debt contracts to determine that accounts receivable are pledged as collateral. Okay, just to verify that. So we don't want overstated information by including any extra information that just doesn't really exist. But again, primary problem completeness. We don't want to understate information. So all disclosures that should have been included in the financial statements have in fact been included. Nothing has been omitted, nothing is understated. So something here that we should do is to use the disclosure checklist to determine if the financial statements include all disclosures required by accounting standards. So firms do have disclosure checklists, not necessarily that we examine one, but just making sure that major things that should be disclosed really have been. So it's a really good way to document that sure enough, we've done that. Then, classification and understandability. So financial information is appropriately presented and described, and disclosures are clearly expressed. So example of substantive procedure, we'll review the financial statements to determine if assets are properly classified between current and non-current or long-term categories. We'll read the footnotes for clarity, making sure people can actually understand them. Then accuracy and valuation, making sure the right amounts are there. So financial and other information are disclosed fairly and appropriate amounts. So an example of procedure here is to reconcile amounts included in the long-term debt footnotes to information examined and supported in the auditor's long-term debt audit files. So we're making sure in those long-term debt audit files, we have long-term debt contracts because they pertain to multiple years. And we make sure that all information in footnotes, etc., matches up in the way of detailed time. So things are accurate. Any questions there about presentation disclosure? Righty. Well, then the next thing is to review for contingent liabilities. Now, with contingent liabilities, we've seen them in financial accounting, and they differ from so-called actual liabilities. For example, an account payable is an actual liability. We actually know the client owes it, and we know the actual amount they owe. So cut and dried. On the other hand, a contingent liability is much more subjective. It may be subjective as far as the amount and as far as whether the client may owe it in the future. For example, many lawsuits are contingent liabilities. So someone's suing the client. Let's say that a customer slipped and fell on the client's premises. That's another thing you have to worry about in brick and mortar retail stores. You don't have to worry about that in online commerce though. So let's say somebody slipped and fell. It was wet and they slipped and fell on the floor. All right, so they're suing. And by the way, is there any shortage of lawyers to accept the case? No, not whatsoever. They could call who? Who might they call in the way of a law firm? Morgan, it's exactly what I was thinking of, yes. So John Morgan will be happy to assist. Or another one they might call, I hadn't heard about them in a while, but I saw a billboard on I-4 the other day, 411 pain. Remember that? Yeah. Oh, I'm in pain here in the emergency room. Well, or actually, I think you're supposed to call me before you go to the emergency room. So 411 pain. Okay. So before you go to the emergency room, well, you could go to like one regional hospital, or you could go over on Florida Avenue to the emergency room there, which I think is really weird. A freestanding emergency room not connected to a hospital, but they're popping up all over the place. And as I understand, they are extremely expensive. They're just a souped up minor emergency clinic. So don't go. Yeah, you know the one I'm talking about, across from Walmart, yeah, South Florida. So yeah, emergency, no, it's ER 24-7. That's it. So emergency room not connected to a hospital. As I understand, they will transfer you to a hospital if you need to go, but it's connected with hospital in Brandon. So they're going to transfer you all the way over to there. But extremely few cases going to these freestanding emergency rooms ever need to go to the hospital. They're just cases for which a minor emergency clinic would have done okay. Yeah, so just like the Owl Care Emergency Clinic just north of that freestanding emergency room, you know, go to Owl Care instead. Save you money. So a contingent liability, like a lawsuit, we're not sure of the exact amount the client will owe. That is up to the court. Second, we are not even sure the client will actually owe it, which is why in financial accounting we discuss that if the amount of the loss can be reasonably estimated and that the probability of loss is probable, so 90% sure the client's going to lose, in that case, we should do what with this contingent liability? Accrue it and disclose it in the footnotes. Well, then, if the possibility of loss is only reasonably possible, not probable, and or if we cannot reasonably estimate the amount of the loss, then we only disclose it. On the other hand, if the probability of loss is remote, then we don't do anything. Okay, so remember that. Now, in reviewing for contingent liabilities, this partly ties into out-of-period liability test, which we will discuss in Chapter 18. Thus, many contingent liabilities may have been found here. Out-of-period liability tests just involve the auditors searching for liabilities during field work that were liabilities back here on 1231. So for example, if we see a large payment the client's making during field work, we'd like to make sure that there's a liability for it back here on 1231 if it is related to paying off a liability. They might be paying off something like that lawsuit. So out-of-period liability tests, just searching for liabilities here during field work, which pertain to the previous fiscal year. So we might find some contingent liabilities there. But there are also some additional tests performed. One thing that we will do is to inquire about additional contingent liabilities. So ask the client, are there any other contingent liabilities you have? This should be documented in the letter of representation, which we'll see later in the chapter, not today, also known as the client representation letter or management representation letter. That is required, is written from the client's management to the auditor. It documents very important things that we've inquired about. We want those things in writing, even if we inquire about them orally, because what's better, oral inquiry or written inquiry? Written is safer. Back things up in writing. And that's exactly what this is. So we may ask orally, do you have any other contingent liabilities? But back that up in writing. It's a very important statement to get from management. And if management knew about some contingent liabilities, but they did not disclose them to us, and then we found out later the management had been hiding these, ooh, what about management's reputation to us now? It's not good. They better come clean. That would be a client imposed scope limitation. Could definitely lead to less than a clean opinion. Another thing we should do is review minutes of stockholder and board of director meetings. So just make sure that since they discuss big things, those could be contingent liabilities. Then we will also review dealings with legal counsel with the client's lawyer. One good procedure is to examine the legal expense account to determine the reason for each expense. So we see these expenses you paid to your lawyer. Why did you go there each time? It's a really good way of finding things. And the auditor should also inquire about existing and pending litigation with the client's attorney. I will show you in a moment. And this is going to request an opinion as to the probable outcome, damages, and existing and potential legal problems up to the audit report date. Now, attorneys are sometimes reluctant to reply because they feel they may compromise cases. However, if they refuse to comment on information which is within their purview, that constitutes scope limitation and could cause the audit report to be modified, not clean. It's a scope limitation. That's why. Couldn't examine everything we wanted. And note this inquiry is non-biased. The auditor may have to contact an independent attorney to obtain a second opinion. So let me show you here in the book on page 772. So typical inquiry of attorney, and there is no standard letter for this, but this one comes from PPC software. They have a template there. You can simply tailor make to your individual client. So there are best practices, shall we say, which are reflected here. So what the auditor would do here is that they would formulate this for the Hillsburg Hardware Company, and here's your letter, management, please sign it. So they've got their attorneys over on Michigan Avenue in Chicago. And I guess if you're in Gary, it sounds a lot fancier. You have a lawyer from Chicago, right? Yeah. So let's see what this says. And again, very typical language for one of these letters. So our auditors, Berger and Anthony CPAs, are conducting an audit of our financial statements for the fiscal year ended December 31st. In connection with their audit, we have prepared and furnished to them a description and evaluation of certain contingencies, contingent liabilities, including those attached, involving matters with respect to which you've been engaged and to which you've devoted substantive attention on behalf of the company in the form of legal consultation or representation. For the purpose of your response to this letter, we believe that as to each contingency, an amount in excess of $100,000 would be material and total $700,000. So don't worry about small stuff. Like there's a little slip and fall for a couple of $1,000 because they went to that freestanding emergency room. Actually, they probably charge even more than that, as I was reading. So, well, anyway, we're not going to sweat that. Too small. However, determination of materiality with respect to the overall financial statements cannot be made until our auditors complete their audit, so kind of a way out there. Your response should include matters that existed December 31st and during the period from that date to the completion of their audit, anticipated to be about March 15th. So please provide to your auditors following information. Well, first such explanation, if any, do you consider necessary to supplement the listed judgments rendered or settlements made involving the company from the beginning of this fiscal year through the date of your reply? So any judgments in court, or if we settled out of court, tell our auditor about that. Well then, such explanation, if any, that you consider necessary, supplement the listing of pending or threatened litigation, including an explanation of those matters as to which your views may differ from those stated, and identification of the omission of any pending or threatened litigation claim or an assessment, or a statement that the list of such matters is complete. So if there's anything else, let the auditor know. With pending litigation, that's in court, so please comment on that. Threatened litigation, well, they haven't sued yet, but they are threatening to. So somebody slipped and fell, and Morgan & Morgan is saying, well, we're going to sue. That's threatened litigation. And I'm assuming that Morgan & Morgan does have an office in Chicago. They've gone pretty much nationwide because I've seen their billboards in other cities. So I think I saw one in Chicago. If not, I'm sure they'll get there one day. If not, you think there are plenty of other lawyers? Of course, please, a place like Chicago, lots of lawyers there. Way more lawyers than accountants. Yep. Now, accounting can be good going to law school to specialize in something such as tax law or corporate law, but people to go to law school that don't have an accounting background, they've majored in political science or English, they just don't have the advantages that accountants do. So if they go into general law practice, how good will that be? Not very, no, not at all. A while back, I was reading about law school at Valparaiso University, which is just a little bit north of Gary, Valparaiso, Indiana. And the law school's existed since like 1875. I mean, it's a really old law school. But in recent years, their graduates just haven't been getting overly good jobs for the most part. So a lot go into fields where a JD is not totally necessary. And that's happening with law schools across the country. So Valparaiso being a rather good law school that has turned out a lot of judges, for example, in that area of the country. Well, their graduates are having trouble getting jobs, and that just reflects the overall supply of lawyers out there. There are a lot of them. So, yeah, too bad. Oh, well. Anyway, that means lawyers are hungry. That's why we see ads for Morgan & Morgan and other lawyers and 911 pain, etc. Well, then number 3, such explanation, if any, that you consider necessary, supplement the attached information concerning unnecessary claims and assessments, including an explanation of those matters as to which your views may differ from those stated. So unnecessary claims and assessments. Nobody is sued yet or threatened to, but it's probable they will. A lot of consumer action lawsuits fall under here. So let's say that there's a defect in our product. Nobody's sued yet, but we know they're going to. That would be an unnecessary claim or assessment. Okay. Then finally, we understand that whenever in the course of performing legal services for us with respect to a matter recognized to involve an unnecessary probable claim or assessment that may call for financial statement disclosure, you've formed a professional conclusion that we should disclose or consider disclosure concerning such possible claim or assessment as a matter of professional responsibility to us. You will so advise us and will consult with us concerning the question of such disclosure and the applicable requirements of accounting standards. That is a run-on sentence, but those are common in legal documents. Complicated. Please specify, or please specifically confirm to our auditors that our understanding is correct. So if the very end, please specifically identify the nature of and reasons for any limitations in your response. So there we go. Signed by the president of the Hillsburg Hardware Company. Of course, authored by the auditors. So that'll be sent over to their lawyers, and hopefully their lawyers will provide all the information that is needed. By the way, this is called inquiry in the way of an audit procedure. Until probably 10 years ago, this used to be called confirmation. But then the title was changed. The reason being that the lawyer is sort of an extension of the client. This is not true unbiased confirmation like we would get from a totally independent source. The lawyer is very biased to say, yes, we'll win, or if we don't win, it won't be that bad. So it's inquiry, not confirmation. Well, then some other things we should do to try to identify some other contingent liabilities. We should review the provision for income taxes and any revenue agent reports. So if the IRS is threatening to collect something, could be a contingent liability. Then we'll review any lines or letters of credit and confirm them. A line of credit, a good example would be a home equity loan where a client could borrow from that line of credit at any time. Then number 6, review commitments such as for purchases, pension plans, profit sharing plans, and warranties. So purchases, purchase contract, usually we have to buy a certain minimum amount by a certain date in order to get a lower price than that offered the general public. If it looks like the client will not be able to meet that purchase contract, the price usually goes up to the normal price offered the general client to the general public. That difference would be a contingent liability. Pension plans, well, if you've had pensions in financial accounting, has anybody had them yet? Okay, did you like them? Not so much, nah, me neither. Well, there is a contingent liability there, and it's contingent upon the recipient of the pension living. Yes. Profit sharing plans, kind of a similar contingent liability there. Warranties. Well, when we estimate future warranty expense in financial accounting, we debit warranty expense and we credit a contingent liability for future warranties. So contingent upon this product breaking down. Then number 7, we'll review transactions after fiscal year end, overlaps without period liability tests. So we're going to review transactions occurring during field work to see if there's any liability from back here at the end of 2020. Then number 8, finally, just being aware of news items with the clients, because there could be contingent liabilities here. Well, most auditors maintain a clipping file of news items which they gather throughout the year. That task is a lot easier now due to online databases like the Wall Street Journal, various databases related to news about publicly traded companies. So if we see that there's a defect in the product and people are starting to sue, might have a contingent liability. So that's why we'll go ahead and cover today. I don't want to get into the next topic and break it. So any questions so far? Do you have any questions, Jakey? Okay, very good. All right, well, have a good one. I will see you back on Wednesday. Bye-bye.